All right, what's going on, everybody? Welcome back to the channel. It's Millennial Trades. It's January 9th, 2023. We've got a lot of stuff to talk about in this video. I might talk a while. I might not. You might want to get a cup of coffee, maybe a cup of tea, and we'll try to analyze this together. Feel free to leave your comments down below, your thoughts, because sometimes I don't even know what to make of all of this. Basically, with the markets, we had a pump and dump. I mean, that's what it looked like to me. We had major supply zones that were being kind of just blasted through by the NASDAQ and the S&P 500. I was watching the futures, and we came right back down. I think the futures might have closed a little bit higher, like 0.01%, I think is where the NASDAQ futures closed. But these markets, they got pumped and they got dumped. Dollar as well had another pretty bad day. I mean, the dollar's chart doesn't look great. We kind of broke that level we were consolidating at a couple of weeks ago. I thought we would break above that level. We did not. We actually broke below it. So the dollar index, the DXY, looking fairly bearish, but who knows what's going to happen tomorrow. So still very choppy, very tricky to trade these markets. I did manage to get in and out of a PayPal scalp. Scalped a little over $200. My account's a lot smaller now. It's like $3,000, and I am making an effort to trade smaller. I only put on 5 contracts. I kind of scaled into that position. Could have gotten some better prices, for that first dip, but I managed to get out, with a $200 profit with only about 5 contracts. So, I think I did well in executing the trade in a manner of, thinking about risk management, thinking about position size. And so this is stuff I'm going to be focusing on going forward. European stocks hit 7-month highs, and I keep seeing these Europe markets rise, and it's, I guess it gives me a little bit of optimism for the U.S. markets, and we just can't seem to catch the same momentum that these European stocks. They also had their jobless rate at 6.5%, which is near record lows. So I'm not exactly sure what that means. It seems to conflict a little bit with the idea that these markets should be rallying. But really, there's no reason ever for the markets to rally. They could rally. I mean, just look at 2021, 2020, very high valuations. We're going to talk about all that as well. The banks are saying that the markets are still way too high. You have oil up, but still below $75 a barrel. There's some optimism. China, we do have a little China oil story because they're really trying to work out a deal, at least regionally, to transact in yuan when it comes to these oil contracts between the different nations. And the dollar, dollar looking pretty bad. I mean, it was consolidating the last couple of weeks. I thought we would break above that level. That's what I was calling for. We did not. We actually broke below that level on the dollar. So take that for what it is. To see the dollar go down today, that did give me some confidence, because the dollar was down, even before the stock market had opened. The DXY. That gave me confidence that, we'd get a little bit of bullish momentum, going at least into the morning here, which we did get that. But it was all wiped out, all of it. So major pump and dump. In this video, guys, I want to discuss a few different things. I want to discuss China and oil. We've got more Fed news, more Fed ghouls coming out with their interest rate favors. And we've got some bank news, some major statements from banks, as well as layoffs. And then we're going to talk about the labor market a little bit. It kind of ties in with the layoffs. So let's go ahead and get into all of this here. The first thing I want to hit is the China oil news. China's leveraging itself as as the world's biggest oil importer. And so for China to transact for oil in dollars doesn't make a lot of sense for China. And the mainstream media kind of blames Russia's invasion of Ukraine for China and other countries interested in breaking away from the dollar and maybe creating a petro yuan or something like that, some sort of commodity-based currency alternative to the dollar. The mainstream media here in the West blames Russia's invasion, but it was actually America's reaction to Russia's military invasion, cutting off Russia, capping their oil, weaponizing the dollar against not only Russia but other nations as well. So it makes sense that these nations are going to kind of come to some agreement eventually to transact in a way that can rival the dollar. To me, that makes perfect sense. I mean, that I don't see how it's going to go any other way. The dollar eventually is going to face some sort of competition. So Beijing's pushing for the petro yuan for as a currency for their oil deals in Asia specifically. And this is the other thing that makes sense too. If they're transacting amongst each other, let's say Russia and China, China and some of these other Asian countries, why the hell would they use dollars? Or why would they want to use dollars? Especially knowing that the dollar could be weaponized against them at any moment, at any time, for any reason. They could just start seizing yachts off the coast of Asia somewhere. So could we see the dollar challenged in these commodity markets? Could we see the dollar facing more and more challenges in the commodities markets? And it's not just oil. You're talking about uranium, gold, silver, all kinds of different metals. So it's naive to think that China is not going to seek to control not only a currency that it can transact for oil in, but also control the price of oil. You also had the China-Saudi deal last month to carry out yuan energy deals. I think it's only about like $60 billion or so. But Saudi Arabia as well is interested in being able to transact for their oil in yuan. Because these other countries, they kind of see perhaps where this could go a few years from now, 5 years from now, 10 years from now. So can America continue to use the dollar in the way that it has without these sort of repercussions? Most of the analysts that I'm reading tend to think not. So we got that out of the way, right? And we'll keep watching the oil price. Again, it's still below $75 until oil kind of goes past 80, 85. There's not a whole lot to talk about there, but there are some demand optimisms because of China's supposed reopening and the end of the zero COVID policy and all this kind of thing. All right, Fed Ghoul news. This is my favorite segment in every video is the Fed Ghoul news because they're always talking shit. Every single one of them. They're always saying something. We do have Powell speaking in Sweden at a bank symposium. He's going to be speaking on the importance of central bank independence. But today, we had the Atlanta Fed President, Raphael Bostic, saying that he favors holding the rates above 5% for a long time, for the foreseeable future. And, of course, there's a lot of Fed speak. It's very vague. It's usually very arbitrary, but it does move the market sometimes. And it also maybe gives us a hint as to what we can expect at the next FOMC meeting. Not only Bostic, but you also had San Francisco Fed President Mary Daly as well, echoing basically the same statements, saying that she favors a 5%, above 5% rate for a long time. And again, just the comments were very vague, very arbitrary, but Jim Bullard a couple of weeks ago talking about 7% interest rates. I think we had, who else was it? Yeah, Esther George favoring very high, above 5% interest rates. So if all of these Fed presidents from coast to coast are talking about, above 5% and keeping them there for a while, it could be an indication as to how the next FOMC meeting is going to go. I know there's speculation that it could be between 25 and 50 basis point rate hike. And we're sort of in the second phase, perhaps, right? There was the first phase, which was raising the interest rates aggressively, going from 50 basis points to 75 basis points and doing this, months on end. Now we could be in the second phase where they're just trying to get it right above 5%, maybe 5.25, 5.50 could be the nominal rate, maybe higher, but, keeping it there, right? Just keeping it elevated for months, maybe years on end. That could be like the second phase that we've now entered when it comes to these rate hikes. Mary Daly as well said that 25 to 50 basis point rate hike is possible at the next FOMC meeting. So definitely something to ponder, definitely something to think about. You guys let me know what you think in the comment section down below. Will they go way past 5%? Could we see 6, 7% interest rates like Jim Bullard was calling for? I know he's the loose cannon, right? He's the fun guy. He's the clown at the Fed, but could there be some truth to it? Who knows? I guess we can only speculate. Time will only tell. Let's talk about some of the commercial banks. We have statements from Bank of America and Morgan Stanley. And these are dire warnings to their own investors. Bank of America says that valuations are still too high and the market has a 30% downside. Then you had Morgan Stanley today as well, saying that the S&P 500 is going to drop another 20% from its current levels. They're telling their investors this. This is a quote from Morgan Stanley. Investors should brace for a much bigger decline than they are expecting in 2023. To me, this sounds dire. You got Fed people saying we're going to take the interest rates above 5% and hold them there. And then you've got the commercial banks telling us there's another 20-30% downside in these markets. So could we see 3,000 on the S&P 500? I said this yesterday, but I'm getting comments where people are expecting this rally to really sustain. We're going to see the S&P 500 hit 3,500 before we ever see sub 3,000. So what do you do with this information? Well, I think this information, at least for the next 6 months to a year, it kind of tells me I don't want to be settling too much in these stocks right now. I kind of want to remain liquid. And I talked about liquidity a couple of days ago on another channel. But I did part with probably about 80% of my silver and gold, my physical silver and gold. And I had to, especially after the big loss, all right, in my trading account. I wanted liquidity. I just wanted to beef up my bank accounts with cash. I probably took, nearly $1,000 haircut just from losing the premiums. But I was glad that I had stacked all that silver and gold the past year or so, because at least it was there and at least I had it when I needed it. And that's really what it's there for. I'm not keeping it just because I like hoarding silver and gold. I like having it because there's a security there about it. And if I had just kept and I got about, it was like $4,000, it was over $4,000 that I got for, it was about 120 ounces of silver. There were some Morgans in there and stuff. And then I had a few pieces of gold that I sold as well. And so, I might have spent about $5,000 on all of that. But if I had just kept the $5,000 in my bank this whole year, who knows? Would it have still been there? I don't know. It's hard. Cash is so liquid, it can be very, very hard to hold on to. But I needed to beef up my bank accounts because, if I come up short on something in the next couple of months, a car payment, rent, whatever it may be, it's there in my bank account now. It's not just locked in my safe. But I was glad that it was there. And I'm going to continue to rebuild the silver and gold stack. The premiums are kind of like, you have to pay a premium if you hold cash anyways, like with the inflation rate. We've been paying a 7% premium just for holding cash. You're losing like 7. That's a huge, substantial cut. If you're going to hold, let's say, $10,000, $50,000, $100,000 in cash, taking a 7% cut every year on your purchasing power. So you're going to face premiums regardless. There's a cost for money. It doesn't matter if the money is cash, metals, you're talking about stocks or different assets. There's a cost for all of this. And now the borrowing costs are going up. So, building credit in these markets, I think it is critical, which I'm doing. I actually just paid off a loan Friday. Paid off the rest of a credit builder loan. I've been working with the credit unions. They offer a lot of these very interesting products. I would tend to say instead of focusing on like CD accounts and all this kind of bullshit, you get a 4.5% return on what? $10,000. You'd need $100,000 to really even. And if you have $100,000, why aren't you trading and investing with that? So these CD accounts don't make any sense. But the credit unions, and the banks, they keep offering me these CD accounts. I'm not interested. I don't want to tie up my money for a year for 4.5% when I could, make 7, 8, 9, 10% a day in my trading account. Yeah, that comes with risk, comes with major losses sometimes. But yeah, the building credit, I think, especially in this environment, is going to be critical, because if you could build credit, this is my understanding. If you can build credit in this kind of environment with these high interest rates, because a lot of the times you can get an unsecured credit card, and as long as you make the payments on time, you're not paying any interest. If you don't make the payments on time, it's like a 20%, 22% interest rate, but could be higher than that. But I've been building credit the last year because my credit was in the toilet, and I have to get my credit up. I'm getting closer and closer to, probably like 600, which it's a big accomplishment, because I was in the depths. My credit was just, it was bad. So I'm building credit, and for me, that's critical. Liquidity, credit, trading. I don't want all my money right now locked up in stocks, or locked up in the metals, or locked up in any of this stuff. I want liquidity, because if I have liquidity, I can trade every day. If I have liquidity, I can pay bills easily. If I have liquidity, the cushion is there. So in my opinion, I think focusing on liquidity and also building the credit, building the cash savings, but building the credit is just going to be critical, because then when the interest rates come down, if they ever do, and the cost of borrowing, you're looking at some opportunities in the future, potentially. So all of that being said, I know yesterday I went kind of hard on the labor market, but again, it's just all bad news. We got to talk about the labor market before I end this video. It's just all bad news, guys. I mean, the nurses are going on strike. Like 7,000 of them walked out. They're going on strike basically because there's too many patients, right? They claim that it's not safe. Nurses are having to tend to 4 or 5 different patients in the ICU, and it's just not a doable job. That's what they claim. And I'm sure the nurses do have, a hard job, but it's like a lot of these people, they're going into these fields, they're getting these degrees, they're signing up for this kind of work. And sometimes these are like, in the medical field, that's like a dream career for some people. They're not happy. We almost had a railroad shut down, back in November. They're coming for their 2 weeks of paid sick leave. I guarantee it. They're going to come back for that. And the labor market's important to focus on, because we understand the economy. We understand the health of the economy when it comes to labor. So when you see all these layoffs, especially in these white-collar jobs, these tech jobs, Goldman Sachs laying off 3,400 people this week. Peter Schiff was right, when he said right before Christmas, after the holiday, we're going to see a new wave of layoffs, because, nobody wants to be the Grinch and fire people right around Christmas or New Year's. But we're way past that now. Well, I know the Orthodox nations, Russia, Ukraine, they're still celebrating Christmas and New Year's. But the ecclesiastical New Year actually starts in September. I'm not going to get into all that right now. But, yeah, these layoffs, man. And then to see the employment number go up. The unemployment number went down. I think, what did we say it was? I think it came down. It came down below 7. It came down to 3.5%. I think is where the unemployment was on Friday. 3.5%. And they need it higher. Well, we went from 3.7% to 3.5%. So that wasn't good. That was not good as far as, thinking about the nominal interest rates and all this kind of thing. But seeing the wage data, wages down to 4.6%, that whole thing was fueling the rally. You had the unemployment going down, you had the jobs being created, but you also had the wages going down, which the Fed has said they really want to see that. So that might be fueling some of the rally that we're seeing. And these bear markets can be, the rallies can be violent. We could see some wild moves in the stock market before we ever see the new lows in 2023. But I'm reading these books like Too Big to Fail, and trying to get informed about the 2008 financial crisis and exactly what happened. I think it was Credit Suisse, some foreign bank had a lot of exposure to bad collateralized debt obligations, CDOs, right now. And this is the same kind of thing that I'm reading about in these books from 2008. All these layoffs as well. You just can't help but wonder. Nothing says trouble like banks having to lay off tons of employees right after New Year's. You really can't make this stuff up. And then all the dire warnings from the banks. Morgan Stanley telling their investors that This is their quote: "Investors should brace for much bigger declines than they are expecting in 2023." So I don't want to be like a perma bear or anything, or like hate on the markets and hate on the labor force and all this kind of thing. But it just seems to me that and then I read this other article too. Where was it here? Slackening labor market to serve as a tailwind for restaurants. This article from Seeking Alpha basically talks about all these people in the white collar jobs. They're gonna be running to Domino's. They're gonna be signing up to deliver pizzas. Who wants to deliver pizzas, especially if you've been working at Amazon and I think the Domino's up the street for me, they pay like $18 an hour, but you got to provide your own car and all this kind of thing. The whole thing's a scam. Like if you got to drive your own car in these delivery services, it's wear and tear on your car. I don't see how Uber drivers are, even if you're making money as an Uber driver, as a Lyft driver, as a Domino's pizza delivery driver, even if you're making money, serving tables or whatever, what's your quality of life? How many hours a week are you working? How many days a week do you have off? These are all kind of things that don't really get factored in when we're being propagated this narrative that all these white collar workers and I guess bank employees are going to be, driving pizzas or driving Uber. I don't buy it, guys. I really don't buy it. This article talks about the wage inflation escalation. McDonald's and Starbucks have called out the trouble of escalating wages. But, they're the ones that are advertising $15 an hour, $18 an hour. But now they're saying, there's a trouble with escalating wages. Well, they're the ones that are getting to choose these higher wages. Minimum wage is like what, $12.50 or something? For the latter, and here's the other thing too. They talk about the baristas, specifically at Starbucks, demanding these higher pays, demanding things like, making demands when it comes to like paying for education and stuff like this. If somebody's making coffee for a living, it's productive to a certain extent. It provides a service, but we have to be realistic too with how much we should expect to be paid. I wanted higher and higher pay, and I fought for as high as a pay as I could possibly get when I was working at the warehouse. But you're always going to be capped, and your hours are going to be controlled. Your life is going to be controlled. And I think Americans are looking for ways out of this, but whether it's side hustles, whether it's I'm hearing more and more about the 4-day work week. Some companies are going to start experimenting more with the 4-day work week because they feel like, if somebody comes in for 10 hours, 4 days, they're going to be more productive because they'll have some time off. They can recuperate. And to me, that makes sense. 4-day work week definitely makes sense because when Americans are working 60, 70, 80, 90 hours a week, how productive are you going to be? How long can you do that before you get completely burned out? I don't care if you're making $25 an hour. How long can you do that before you become completely burned out? So, and the turnover rates too, the quit rates. It's crazy out there. It is crazy what is going on in our service sector, what's going on with these massive layoffs. To me, none of this looks good. Again, I don't want to be the perma bear here, but none of this shit looks good going forward. So I'm going to continue doing what I'm doing. I'm going to be following these markets, even if I don't totally understand the information and maybe I'm analyzing it improperly or incorrectly, hearing back from you guys and getting different ideas online. There's no other way to really figure this out. You just got to figure it out for yourself and experiment a little bit. But I think right now liquidity is extremely important. I don't think the dollar is going to completely collapse, next month. So I'm perfectly comfortable keeping tons of cash on hand just in case, just in case something happens in my trading account, just in case something happens. I'm diversified with my banks as well, which is also important because there's rumors, speculations that liquidity issues like we saw with FTX are going to spill over into the mainstream bank, especially banks or investors, big investors that have heavy exposure to the crypto markets. So lots of things to look out for, lots of things to watch. You guys let me know your comments down below. And I'll leave some of these articles, the links to some of these articles, the China oil article, the Fed Gouls, and maybe the bank news, some of the labor market. I'll leave the articles down below because, if you go in and start reading this stuff, I mean, it's just crazy what they're trying to convince us of. So follow me on Instagram at Millennial Trades. And as always, until next time, I'll see you on the next video.